Welcome, everyone. Settle in, grab your coffee, and definitely get your notes ready. Today, we are diving deep into a truly pivotal area of the ICAEW ACA Business Planning Taxation Syllabus for 2025. We're taking a dense masterclass approach to Chapter 21, which is all about the transformation of owner-managed businesses. Now, I want you to approach this material systematically, deliberately. It's like a giant puzzle. And we're going to dismantle the complex tax mechanics of moving a business from a sole trader to a corporate structure and actually even vice versa.
Okay, let's dive into this. Here is our chronological journey for today. 1. Overview of transformation. 2. Income tax and losses. 3. Capital gains tax reliefs. 4. SDLT, VAT, and corporation tax. 5. Disincorporation and bankruptcy. And finally, 6. Those all-important essential exam strategies.
Section 1. Overview of business transformation. Let's get the foundational concept down.
So, when a sole trader decides to incorporate, they're not just changing their nameplate, they are embarking on a massive legal shift that literally cascades across every single major tax head. You absolutely cannot view this through just one lens. To truly grasp the mechanics here, we have to look at incorporation as two things happening at exactly the same time. It is simultaneously the permanent cessation of an old trade and the birth of a brand new investment. The individual completely stops their unincorporated business. In exchange for handing over those business assets, they get shares in a newly formed company. That company then takes those assets and starts its own trade. It's this dual perspective, ending one thing to start another, that dictates every single tax rule we're about to cover.
Moving on to Section 2, Income tax and losses. This is exactly where you start your exam computations.
Because incorporation equals the cessation of a trade, the standard tax year basis rules kick in for that final period, and all your capital allowances pools slam shut. Now, before we even dream about transferring assets, we have got to deal with any trading losses that piled up before incorporation. There is a strict, logical hierarchy of reliefs here. First up, Section 64. That lets you set losses against your current or prior year total income. Simple enough, right? Then, Section 261B can step in to extend that relief to chargeable gains. For the final 12 months, you've got Section 89 Terminal Loss Relief, which gives you a fantastic 3-year carryback on a last-in, first-out basis. Oh, and quick side note, making a succession election under Section 266 within 2 years is a lifesaver because it allows plant and machinery to transfer at tax-written-down value, totally avoiding those nasty balancing charges. But what if after all that you still have unused losses? Well, enter Section 86.
Section 86 is your incorporation loss relief. It allows those leftover sole trader losses to be carried forward and set against the income the individual eventually pulls from the new company. So, the crucial point is the specific order. Listen closely, because this is mandatory. It is absolutely not optional. Step 1, you must exhaust these losses against salary and any other earned income from the company. You have to drain that bucket first. Only once that earned income is fully wiped out can you move to Step 2 and set the remaining losses against dividends and unearned income. You really need to lock that sequence into your brain for the exam.
Right, Section 3, Capital gains tax reliefs. Time for the heavy lifting.
We are now entering the biggest conceptual hurdle of the chapter. Transferring a business to a company is a disposal for CGT purposes. If we didn't have reliefs, the tax bills on the gains would be absolutely crippling. So we have two main superheroes here, Section 162 Incorporation Relief and Section 165 Gift Relief. Let's compare them because they are very different beasts. Section 162 applies automatically, but here's the catch. It requires literally all assets, with the exception of cash, to be transferred. The gain doesn't vanish, it's held in suspense and rolled right into the base cost of your new shares. And critically, business asset disposal relief, or BADR, is not available on the deferred gain when you incorporate. Now, on the flip side, Section 165 Gift Relief lets you cherry pick. The individual can retain certain assets, like a property, and just transfer the rest. Here, the deferred gain actually reduces the asset's base cost inside the company. And this brilliantly illustrates how the all assets requirement entirely dictates your choice of relief. You have to know exactly what the client intends to do with their property.
Let's pause and talk about goodwill, which is often the most valuable asset sitting on the table. The way the new company treats this goodwill depends entirely on the exact date the original traders started their business. If the goodwill was created before April 1, 2002, it is treated as a standard capital asset under normal CGT rules. If it was created after March 31, 2002, it's classified as an intangible fixed asset, or IFA. But take a really close look at that final column. For both of these categories, if that goodwill is acquired from a related party on or after July 8, 2015, And let's be real, an incorporation is pretty much always a related party transaction. The company gets zero tax deduction for amortization. None. The cost just sits there looking pretty on the balance sheet, offering absolutely no tax relief.
So, knowing that Section 162 demands every single asset be transferred, what on earth do we do if a client stubbornly insists on keeping their freehold property? Well, we use a classic Section 165 gift relief workaround. It's a neat three-step process. Step 1. You transfer all the non-chargeable assets, things like stock and cash, in exchange for shares. Step 2. You deal with the goodwill entirely separately. You either gift it or sell it at an undervalue to the company and explicitly claim Section 165 relief on that transfer. Step 3, the individual simply keeps the property in their own name, and they can even charge the new company rent. And here's a real pro tip for you. If your client hasn't used up their annual exempt amount for the year, don't just gift the goodwill. Have them sell it to the company for a tiny bit above its nil cost, say $3,000. This intentionally triggers a small gain that gets immediately swallowed up by the AEA. You're not just deferring tax there, you are permanently erasing it.
Now, I mentioned earlier that Section 162 applies completely automatically if the conditions are met. But I want to ask you something. When is it actually a smart, strategic move to aggressively disapply this relief? Think about the end game. Think about the exit. If your client defers their gain into the shares today, but fast forward a few years and they won't actually qualify for BADR when they sell, maybe they step down as an officer or their shareholding drops below 5%, they are going to be staring down the barrel of a 20% tax rate. That's a disaster. In that specific scenario, they absolutely must elect to disapply Section 162. They have to do this within 34 months of the end of the tax year of incorporation. By disapplying, they force the gain to crystallize right now while they still comfortably qualify for BADR as a sole trader. They lock in that beautiful 10% rate and walk away happy.
Moving right along to Section 4, SDLT, VAT, and corporation tax. Let's look at the indirect and corporate side of things.
So, we've navigated the capital gains minefield, but we can't forget indirect taxes. A huge, glaring oversight that traps students every year is forgetting about stamp duty land tax. If land or buildings are transferred into the new company during incorporation, SDLT is charged on the open market value of that property. And hear me on this. Do not let the exam question fool you into thinking that because zero cash changed hands, there's no tax. The charge arises regardless. It is an incredibly expensive trap, and if it happens to be residential property, you better remember to factor in that extra 3% surcharge. Neither Section 162 nor Section 165 is going to save your client from an SDLT bill.
Shifting gears to VAT, the news is actually good. An incorporation almost always meets the strict conditions for a transfer of business as a going concern, or TOBGC. If it's a going concern, the same trade, no break in trading, and VAT registration is handled properly, the entire transfer falls completely outside the scope of VAT. This is huge because it avoids a massive cash flow headache. Finally, just a quick reminder that the new entity is now playing by corporation tax rules, and because it's an owner-managed business, it is almost certainly going to be classed as a close company. That means you've got to keep a very close eye out for Section 455 tax implications if the company starts making loans back to its participators.
Section 5. Disincorporation and bankruptcy. What happens when we need to hit the undo button?
We spent all this time building a neat little corporate structure. Now let's look at tearing it down. Disincorporation is exactly what it says on the tin. It's the process of transferring the trade and all the assets out of the company and handing them back to the individual to run as a sole trader or partnership again. Clients usually want to do this if the administrative headaches and costs of running a company start to outweigh the tax benefits. But there is a massive, immediate consequence you have to warn them about. The very second that company ceases trading, every single penny of unused trading losses trapped inside that corporate shell lapses permanently. Poof, gone. They absolutely cannot be passed back to the individual.
I want you to literally burn this phrase into your memory. Disincorporation creates a double tax charge. This is the gravest, most expensive warning you can give a client in this scenario. Think about it. First, corporation tax arises inside the company because it's deemed to have disposed of all its assets at open market value. The company gets taxed. Then, capital gains tax hits the individual because they are deemed to have disposed of their shares in the company. The deemed proceeds they receive for those shares equal the open market value of the net assets they just got back minus the corporation tax the company just had to suffer. It's a brutal double hit.
And just to make sure we've covered absolutely every corner of the syllabus, let's briefly touch on bankruptcy. If our sole trader unfortunately goes bankrupt, it triggers an immediate cessation of trade for income tax purposes, which at least opens up those terminal loss reliefs we talked about. For VAT, the business has to deregister immediately. And for capital gains tax, there are no special magic tricks. The normal disposal rules apply as the liquidator starts selling off the assets.
Finally, Section 6, Essential Exam Strategies. Let's move to and see how this all builds into a battle plan.
We've just covered a mountain of technical tax law. Now we have to synthesize it into an actionable attack plan for your exam. The minute you realize you're looking at an incorporation question, you must immediately ask yourself two diagnostic questions. Number one, does the individual actually want to transfer all of their assets, including their property, into the company? If the answer is no, Section 162 is completely dead in the water, and you must instantly pivot your answer to Section 165, gift relief. Question 2. Will this individual be an officer retaining at least 5% of the shares in the new setup? If the answer to that is no, you have to powerfully argue that they should disapply Section 162 so they can secure that 10% BDR rate right now before they lose it forever.
The mocks in this exam aren't just in knowing the rules, they're in knowing the precise statutory deadlines. You need to lock these three into your memory right now. Want to disapply Section 162? You have exactly 34 months from the end of the tax year of incorporation. Want to transfer plant and machinery to avoid a balancing charge using a Section 266 election? You have exactly 2 years from the date of incorporation. And finally, do you remember that harsh rule restricting bad DR on goodwill transferred to a close company? The only way out of that trap is the 28-day rule. The individual has to sell those shares to an entirely unconnected company within 28 days.
I want to leave you with a final, critical challenge. When you're sitting in that exam hall and you turn the page to an incorporation question, what's your plan? Are you going to panic and analyze the issues randomly, or are you going to apply the structured, deliberate methodology we just built today? I want you to systematically verify the income tax position, then capital gains tax, then stamp duty land tax, then VAT, and finally corporation tax, in that exact chronological order. If you can master this framework, you will absolutely conquer the incorporation question. Thank you so much for your focus and energy today. Best of luck with your studying.